So in just over 2 weeks' time, the UK government are going to be setting out their budget for the next financial year, which is rumoured to include a huge rise in capital gains tax, which is going to affect your crypto profits. So in this video, we're going to be going over what the current capital gains tax rules are, the rumoured changes coming in on the budget, some ways how you can reduce your capital gains tax bill, and also some disturbing rumours coming out of the US election campaign regarding tax changes as well. So strap yourselves in. This could be a long one, but it should be very useful and informative. So enjoy. So we need to start with a quick disclaimer that, of course, neither myself nor Learning Crypto are professional tax advisors or accountants. So nothing in this video should be constituted as financial advice. This is just purely my opinion on things. So if you do need advice, go seek that from a professional accountant or tax advisor. Now, I'm going over some stuff today which I may get into a little bit of a rant every now and then, but I will try and keep it to a minimum, unlike what I do on the Friday morning live streams with Learning Crypto. But with that out of the way, let's get on to the news itself. So starting with this article from The Guardian, I believe it is, which is the rumoured increases to capital gains tax to 39%, which is pretty huge, considering the top rate of capital gains tax in the UK is currently only 20%. So you can see through this article, Treasury modelling being reviewed by the Chancellor and seen in this newspaper shows officials are testing a range of between 33% and 39% for capital gains tax. And of course, as you should already know, any crypto gains that you make do fall under the capital gains tax category. So if we just take a quick look at what that puts us in terms of comparing to the rest of Europe, if we were to increase to 39%, that would actually make us the second highest capital gains tax rate in Europe, just behind Denmark, which currently has the highest at 42%. Now, I don't know what your feelings are on capital gains tax or just taxes in general, but when it comes to capital gains tax, I think that 20% is just about as much as I personally am willing to stomach, in terms of, you got to remember that you get paid your wages, you obviously lose income tax, national insurance, then you've got things like council tax and just your regular bills, utilities and stuff. So whatever money you're left with after that, that is the money you're then using to invest in certain things. And of course, you do all the work in terms of doing all the research, you're putting your capital at risk. And then at the end of that, if you do somehow manage to turn a profit, which as we know isn't very easy, the government then come and take a percentage of that. And as I say, 20% is about as much as I can stomach. Over that, I think it becomes very, very unfair indeed, especially if you're talking 39, 40%, because as I say, you're taking all the risk. It's all your money that you've already been taxed on that you're putting into the markets. And then if you are successful, the government are then taking 40% of those gains away from you for, not wanting to go down the road of politics, but you don't seem to get a lot for that money. So let's take a quick look at where that would place us as well in terms of other places. So the United States is a little bit different. They have sort of short-term and long-term capital gains, but even they are 0, 15 and 20%, depending on how long you've held the investment. So as I say, if we are to go up to between 33 and 39%, that puts us at a very high tax rate compared to the rest of the world. So with that in mind, let's go take a look at what the current rules are before any rumoured changes. So we're currently on the HMRC website, which gives you all of the information regarding tax bands, how you pay it, when you pay it, etc. And currently we're looking at the income tax rates and bands, because these are quite important. The two you only really need to know when it comes to capital gains tax are the basic rate, which is any income you earn between 12,571 to 50,270. And then once you earn over that, you are then in the higher rate of tax. Now, why that's important, if we go over to the capital gains tax, if you're already earning over 50,270 in terms of your income, then you're just going to pay a straight 20% on your gains from other chargeable assets, which is cryptocurrency. If you earn a little bit less, then it gets a little bit more complicated, but slightly better. So essentially what you need to do is you take your income add it to the capital gains you've made, and then anything up until the £50,270 limit is going to be taxed at 10% in terms of the capital gains you've made. And then once you go over that basic rate, anything you've earned in capital gains over that is then going to be charged at 20%. Bear in mind, you do have the £3,000 tax allowance each year for capital gains tax. However, that has been significantly reduced over the past 2 years. It was £12,000, got halved to £6,000 last year, and now this tax year is currently £3,000. There are rumours that they may well get rid of the tax-free allowance as of the day of the budget, so there is a chance that we may even be losing that as well. But as it stands, as I say, you have £3,000 that you can earn in capital gains tax-free each year. Then if you are in the basic rate of tax, you add your income to your capital gains, and any capital gains you've made up until that basic rate limit of 50,250, you're going to pay 10% on, and then anything over that you're going to pay 20%, or if you already earn over £50,250, you're going to pay 20% on all of your capital gains minus the £3,000 allowance. Now that might all seem a little complicated, so of course there are tools on the internet to help you. Now this is a really great website. This is taxscouts.com, and everything you see that I'm using here is completely free. They do obviously have paid services as well, but this is a great website. You can go on and have a quick look at what your capital gains tax is projected to be. Now I'm just going to do a really simple example. So I had a quick little Google on the average UK salary, which comes in at about £35,000 for the average person. So I'm just going to do that, and that obviously brings us under or within that basic rate of tax. So you can see the full breakdown of what this would look like. So what I'm going for is an optimistic profit of capital gains of £100,000, annual salary of £35,000. Now, if you want to do a really detailed look into how much tax you're going to pay, etc., you can include other income. But essentially, I've done this £100,000 profits, £35,000 salary, and then it works out how much tax you should be paying and what your profit is afterwards. And if you go down, you can see the full breakdown. So as you can see here, you pay no capital gains tax on the first £3,000 that we make, as we discussed. Then you're going to pay in this example, you're going to pay £1,527 at 10% tax rate for the next 15,270, because our annual salary of 35 plus 15,270 takes us to that basic rate band limit of 50,270. And then after that, any gains that we've made, we're going to pay 20% tax rate on. And so from this example, £100,000 profit on a £35,000 salary, you're going to be paying a bill of around £17,873. So that's what it is at the moment. Now, as I say, these changes that are coming into the budget, they're looking at a potential change of the highest tax rate, capital gains tax rate, going up to around 39-40%, which is of course essentially double 20%. Now, we don't know what the rumours are in terms of what else they might be doing. As I said before, they might be getting rid of the tax-free allowance completely. They might even scrap the lower rate of capital gains tax. They may just bring it all in line into one tax rate, whether that's going to be 33% like it is in Ireland, or as I say, all the way up to 40%. But if we just take the worst case scenario and say that they are going to increase the tax rate from capital gains tax rate from 20% up to 40%, and you're going to lose the 10% tax rate, and we're going to lose the tax-free gains allowance, then you're looking at potentially doubling this to in around £30,000 to £40,000 tax. So that is a huge difference of a bill from, as I say, about 17,870 all the way up to sort of £40,000. And as I said at the beginning of the video, regardless of what your stance on politics is, what what party you support, what policies you support, in terms of money that's coming out of your account, out of your hands, that you've earned through your skill and your invested knowledge and your and your homework, and your money that's already been taxed that has then been put at risk. In this example, you're essentially paying an extra £20,000 for what exactly? Where are your taxes going? And so when we're going into this budget that's going to happen on the 30th of October, this could all change literally on the day. So it's not a case of they're going to announce the changes and then they're going to be brought in for the next tax year in April. So I personally think it's very important to take notice of this and potentially take some action in ways of potentially avoiding a much costlier bill than it needs to be. So let's take a look at some options that you have with the budget coming up in just over 2 weeks to try and reduce that capital gains tax bill. Now, some important things to remember about the rules regarding crypto and capital gains tax. Remember, I'm not a professional, so do go do your homework and ask a professional to clarify. But of course, every transaction is taxable in terms of going from one crypto asset to another. So it's not a case of you can avoid the tax by only moving in from one crypto to another. If there's any kind of disposal, as it's called, then that is a taxable event. So whether you go to Bitcoin into stables or whether you go from Bitcoin into Ethereum or alt to alt, etc., it is all taxable. So remember that. And also we have the rule in the UK of the bed and breakfast rule. So with the budget coming up in the 30th of October, as I say, you might want to consider crystallizing some gains before that happens so that you get taxed at the current rates rather than what the rates are going to be after the budget or on the day of the budget. Now, you need to remember the bread and breakfast rule that we have in the UK, which is if you sell any assets, you cannot rebuy those assets within the next 30 days. Otherwise, any gains or losses that have been harvested from that transaction are essentially null and void. So as I say, if you want to sell anything and crystallize some losses or gains before the budget, you'll need to take note of the day you've done it, and then you won't be able to rebuy those assets for 30 days. Otherwise, it won't count essentially. Now, a really handy tool that I personally use and we use as a company as well, we've got a link, an affiliate link you can use to reduce your fees. But Coinly is a really good website to track and work out what your potential gains are. It's really handy. This is essentially what it looks like when you make your own account. Shows you your total account value, what the original cost basis is, and then what your unrealized gains are, and also your realized gains if you make them. It's really easy to use. You hook up everything up via an API, and you can also pay for a daily refresh. So literally every day it will resync all your wallets. So any staking rewards, any new deposits, withdrawals, etc., will all automatically be recorded. It hooks up via API or using CSV files as well. So really easy to use, really useful tool. And as I say, you can get all of this for free. You only pay when you want to generate an actual tax report, which again is another lifesaver as well. Essentially, you generate your tax report, you then give that to your accountant, and they send that to HMRC. It's a much easier method than doing it manually. So yeah, definitely take a look at it. And as I say, make a free account, put all your wallets and CSV files in here, and then you can actually see what you're working with in terms of the unrealized gains. So then you can actually make an informed decision of whether you need to do or take any action before the 30th of October. I mean, who knows? Maybe you don't have any gains. It's been a pretty rough cycle so far. But if you do, as I say, find out what you've got, then head over to something like Tax Scouts, put in your information, see what you projected, and then take some potential action. Now, another thing you can do to reduce your capital gains tax bill, aside from selling before the upcoming budget, is utilizing your stocks and shares ISA allowance. So if you're not aware, in the UK, you have what's called an ISA allowance, so individual savings allowance, individual savings account, I should say, and you have £20,000 per year. Hopefully that doesn't change in the budget, that you can invest, and any gains you make are tax free. I currently use Trading 212. It's really user friendly, and there's a lot of perks to it as well. So you can actually put cash into your stocks and shares ISA, and anything that's not invested actually earns 5.1% interest, and it gets paid 5.1% obviously annually, but the interest gets paid daily, which is great for compounding, and that interest is all tax free. And what you can do, of course, is utilize this. Of course, we don't have the ETFs like they do in America. However, you can get access to a ETF, a blockchain ETF, and also the Bitcoin mining company stocks as well. So if you head over to or companies market cap, sorry, you can take a look at all of the Bitcoin mining companies. Now, I'm pretty sure you can get access to most, if not all, of these companies on Trading 212. So as I say, maybe worth looking at either taking some money out of crypto, putting it into your ISA, or if you've got money in an ISA, or you've got some spare money and you've not currently used your allowance, chuck it into a stocks and shares ISA. Obviously, once again, disclaimer, not financial advice, do your own research, but you can get exposure to crypto related assets within your stocks and shares ISA, and any profits you make on that are going to be tax-free. And now finally, the disturbing rumors coming out of the US election, which I mentioned at the beginning of the video. Kamala Harris plans to tax unrealized investment gains, which in my opinion is absolutely terrifying. I don't even know how that would work. Essentially, as you know, at the moment, you pay tax on realized gains. So you buy something, it goes up in value, you sell it, you then pay tax on the profits you've made, depending on the different criteria, etc. But what they're planning is for you to have to pay tax on assets that you've not even sold and realized a profit on yet, which is pretty terrifying. So you imagine if you've got your house and it goes up in value, say £50,000 in that year, they're then going to say, right, your house has gone up in value over the past year, so now you owe tax on that, even though you haven't realized any of the profits made. Now, that is just a very simple example. Obviously, that's not what they're aiming to do, but what they're planning to do is essentially enact this on an individual with wealth above $100 million. Now, of course, immediately you're going to say, well, they're the richest people in the country or the world. They can afford to pay a little bit more tax. I don't feel sorry for them. That's not a big deal. It's not going to impact me. However, unfortunately, that's not the way politics works, and this is how governments get unpopular policies through essentially kind of like the back door, whereby they introduce it to a group of society that not many people are going to have much sympathy for, i.e. The rich. And then they're going to eventually bring this threshold down further and further. So it will start at $100 million, then it'll become $10 million, then it'll become $1 million. And before you know it, unrealized capital gains will just be the norm for everyone, which will be absolutely insane. And then not only that, you've got to imagine that these thresholds, they don't even have to move to eventually bring you in. So even we go back to the income tax bands that we looked at on HMRC, that 12,570, your income is tax-free up until the £12,570 point, but that hasn't barely moved for years, and in fact it's going to remain at 12,570 for the next 4 years under this current government. So when you think about inflation, the cost of things going up and up, you're eventually left with less and less money before it starts getting taxed. So as I say, these thresholds can start very high, get brought lower, and then even once they're brought quite low, you're then going to creep into them just through inflation. So there's a bit of doom and gloom. Let's hope that is not the case. In fact, if we scroll down to the bottom of the article, there's a few quotes here that says there's very little political support for this. Every conversation I've had said it's not going to happen. If you tax unrealized gains, you're going to kill the stock market, which is what I mean by it just being absolutely insane, because there would be massive sell-offs at the end of each year to crystallize, essentially get the profits that are going to be taxed anyway. So it sounds crazy. I really hope that it is not the case and it doesn't come in, but we will just have to wait and see, because I think that if it comes in America, it will eventually bleed over into other countries like the UK, and as I say, it will cause complete and utter chaos. That's just my opinion. As I say, drop in the comments below what your opinion is, what you think of the changes coming up in the capital gains tax, rumoured of course, nothing confirmed yet, and let me know in the comments below what your plan of action is with that budget coming up. Hope you found the video useful. Drop a like and a subscribe if you did, and I'll see you in the next video.